Hi there, welcome back to the channel. In this video, we're going to be discussing gold and how to buy it. You might be worried, for example, about inflation. Perhaps you want to invest in one of the oldest protections against rising prices. I've been looking at holding a proportion of my portfolio as gold for some time, but how do you actually go about it? Well, in this video, we'll find out. I'm Anthony, and as always, we're talking money. Gold has been seen as a protection against inflation for centuries, in fact, thousands of years to be honest. It goes right back to Aristotle's day, who wrote that money in general must be durable, divisible, consistent and convenient, and possess value in itself. Gold, unlike cryptocurrencies, meets all these criteria and has stood the test of time as a good hedge against inflation. The reason why it's so good against inflation is twofold. Gold for some time has been priced in dollars. It really doesn't matter what denomination it's valued in, but at the moment it's dollars. If the value of the dollar goes down during times of inflation, then the demand for the commodity and other commodities like gold goes up. You basically need more currency in order to buy it. A weaker dollar in this case means that you need more dollars to buy gold, i.e. the price has gone up. Also, a weaker dollar against other currencies means that you need less in other currencies to buy gold, so that's just an inbuilt increase in demand. The second main reason why gold is seen as a good hedge against inflation is that the supply of gold is limited, and changes of supply is therefore dependent on mining it out of the ground. Gold is quite rare, so mining lots of it out of the ground is actually quite difficult to do, and so supply sides have actually levelled off in recent years. Price changes are determined by supply and demand, but with limited potential to alter supply, changes in price are almost entirely due to changes in demand. But how to actually buy it? Well, as far as I can see, there are 4 or 5 ways to actually buy gold. The absolute worst way to start with is to buy jewellery made from gold. This is because, well, lots of reasons why this is a bad idea. First off, you've got VAT included in the price, or any other sales tax in which country you're in. The seller's markup, which can be quite hefty on jewellery, and much of the value is actually in the finished article rather than the value of the gold. And also remember that jewellery is never made from 100% gold. It's usually sort of 18 carat, which is 3/4, is that right? Correct me if I'm wrong. And or 9 carat, which is roughly 50%. No, it's not even that, is it? 9 carats, even less. So we can instantly discount this method. So unfortunately, if you're going to say to your wife or husband that you're going to buy a large amount of gold, then you better let them down gently. So what are the other ways that you can invest in gold? Well, firstly, you can buy shares in gold miners. Since the value of gold miners is almost entirely dictated by the price of gold itself, buying shares in miners is probably the easiest way to get exposure to gold price without actually buying the physical metal itself. The additional benefit is that gold miners can also pay a dividend too, so this differs from the actual metal itself that pays no dividend at all. Gold miners include companies like Barrick Gold Corporation and El Dorado Gold Corporation, but you'll find lots in the newspapers and online. The main disadvantage to investing in gold miners is that, like all companies, they are susceptible to company fundamentals like borrowing, management expertise and cash flow, and of course unexpected circumstances as well. So is there a better way of buying gold? You can buy exchange-traded commodity funds from providers like Hargreaves Lansdown. These funds essentially have physical holdings in gold, and it's probably the cheapest and most convenient way to hold gold, as you don't have any storage risk and you can buy and sell quickly if you just want to sell a fraction of your holding. Hargreaves Lansdown is one such company that offers a physical gold exchange-traded commodity fund. That's a bit of a mouthful. But looking at the performance of gold compared to the performance of gold miners, you can see that miners' shares have lagged behind the gold price itself, which leads to the conclusion that holding an ETF, that's an exchange-traded fund, is a better option. But remember, unlike shares, you won't earn a dividend from these ETF routes. The next way to invest in gold is to buy into a derivative market for gold, as they do with services provided by IG Index. Here you can take a position where you can gain or lose for every cent that the price changes in gold. This makes it very easy to benefit from a rising price or indeed a falling price depending on what position you take. This is an incredibly easy way to get exposure to gold, as it's quick to enter and to exit a position, and you can set stop loss limits as you would a normal share. This method is not going to pay you any dividends as you're not investing in any share. And the disadvantage is that you can easily magnify your losses if the price moves against you. And you may be required to deposit more money into your account to cover the paper loss, even if you haven't sold or exited your position. This is called a margin call and generally best avoided, as your position will either be automatically closed out without your say-so, or money will be transferred automatically to cover this extra margin call. The final way to invest in gold is to buy the metal directly. There are lots of ways to do this, and you'll find no shortage of brokers on the internet that can sell and securely deliver your gold to your front door. The Bullion Vault or the Royal Mint are two such examples, but companies like this can either supply gold coins or even gold bars, all at a certified purity, and they also buy your gold back if you wanted to sell it too. Remember that the spread on gold, i.e. the difference between the buying price and the selling price, is much higher than, say, you do with shares, and you also have the additional problem of storage. The cost of storage is not to be underestimated, as you may have to pay additional insurance costs if you plan to keep a significant amount at home, or if you plan on keeping it in a vault, then there'll be an actual storage cost for that too. It's also worth remembering that whereas the price per ounce is lower if you buy big gold bar compared to a small coin, you can't very easily chop a gold bar in half if you wanted to liquidate, say, half your holding. Whereas 5 gold coins, for example, it's easier to sell 20% if you required, rather than 1 gold bar. So I'm tempted personally to go down the ETF route because I think that's probably a cheaper way of doing it. I don't have any storage costs. It's easy to liquidate a little bit of my holding if I don't want to sell the whole lot. And even though it has a little bit sort of less appeal than actually having gold coins and gold bars lying around, I think that might be my preferred way to go. So what do you think? Do you invest in gold already? How do you invest in gold? Do you have a preferred way of doing it? Do you actually keep physical gold, or do you buy shares, or do you buy an ETF? If I've missed something, then definitely put it in the comments below. I'd love to learn how others do it before I perhaps jump in. Anyway, if you want an update on everything else that we discuss here, then hit that subscribe button and the like button. It really helps my channel out. I'm Anthony, and as always, we're talking money. I'll catch you in the next video, but until then, bye for now.